Aflac is the only insurance company in the world that has made a rubber duck its competitive moat, and it worked. The Aflac Duck launched in 2000, took brand awareness from 12% to 95% in 3 years, and turned a business that nobody had heard of into the dominant voluntary benefits provider in the United States and a monopolist in Japanese cancer insurance.
The real moat isn't the duck, it's the product design. Aflac pays cash directly to the policyholder when they're hospitalized or diagnosed with cancer. The money doesn't go to the doctor or the hospital. It goes to the insured to pay the mortgage, the groceries, and the childcare while they can't work. That's a problem no health insurer was solving.
John Amos and his 2 brothers founded American Family Life Assurance Company in Columbus, Georgia in 1955 with $600 in capital. The insight that supplemental cash payments could sit alongside, not compete with, existing health insurance created a product category that Aflac essentially invented and has dominated ever since.
The Japan entry in 1974 was the strategic bet that defines the company. Cancer became an insurable condition in Japan, and Aflac was the first Western insurer to enter the market. Today, Aflac holds 70% of Japan's supplemental cancer insurance market, 26 million in-force policies that renew at 93.8% annually. The book of business is nearly permanent.
The distribution model is what makes renewal so high in both Japan and the U.S. Aflac products are sold through employers as voluntary benefits, deducted directly from payroll. Employees rarely cancel a payroll deduction for a product they can't feel until they need it, which means the policy book is structurally sticky in ways that individually sold insurance products are not.
Daniel Amos, the founder's nephew, has been CEO since 1990. That's 35 years running the same company with the same strategy, optimizing the same flywheel. In insurance, institutional knowledge of a complex regulatory environment and established distribution relationships compounds over decades. Amos is the institutional knowledge.
The 2011 Japan earthquake was Aflac's brand-defining moment. The company paid 10,000 claims within 3 business days of the disaster, faster than any government program or competitor. That speed of claims payment isn't just good service. It's a competitive weapon that reinforces the brand promise at the moment people need it most.
The business model is elegantly simple. Japan at 67% of revenue, United States at 33%. The combined ratio is 70%, meaning Aflac earns 30 cents of underwriting profit on every dollar of premium before investment income. That underwriting discipline, combined with the float on $100+ billion of policyholder funds, creates a business that profits in low claim years and still profits in high claim years.
The insurance metrics confirm the quality. Benefit ratio of 50.3%, claims and benefits as a percent of premium, expense ratio of 19.7%, combined ratio of 70%, well below the 100% break-even line. Operating ROE of 15.8%, institutional quality returns that reflect the pricing discipline of a company with genuine market power in its core product.
The interest rate thesis is the most interesting catalyst of the next 5 years. Aflac's $100 billion investment portfolio has been invested at below-market yields for 15 years because Japanese rates stayed at near zero. The Bank of Japan ended negative rates in 2024. Each 100 basis points of reinvestment improvement on that portfolio translates to roughly $1 billion in additional pre-tax income.
The dividend record is 42 consecutive years of increases, a dividend king. Fewer than 50 companies in the S&P 500 have achieved that. From $1.12 annually in 2019 to $2.20 in 2024, growing consistently. The payout ratio leaves significant room for continued growth as earnings expand.
On the competitive radar, Aflac scores 92 on Japan market share and 95 on supplemental insurance moat, the highest scores in the peer comparison. The yen currency risk score of 45 reflects the structural exposure. 67% of revenue comes from Japan and is denominated in yen, which introduces FX volatility that management partially hedges but cannot eliminate.
The network is focused but enormously deep. 50+ million policyholders, 750,000 employer accounts, 70% market share in Japan cancer insurance, 12,500 employees serving that book, one of the highest productivity ratios in insurance. reflecting the renewal economics of a product sold once and retained for decades.
Aflac built the most durable insurance franchise in the world by solving a problem that health insurance doesn't: the income gap, when a policyholder gets cancer and can't work for 6 months while copays and living expenses pile up. And the supplemental cash payment is so simple and so necessary that 70% of Japan's working population carries an Aflac policy.
The investment thesis today is about the interest rate cycle. Aflac's $100 billion investment portfolio has been earning below market yields for 15 years as Japanese rates stayed at zero, and as Japan normalizes rates, each 100 basis points of reinvestment improvement translates to roughly $1 billion in additional pre-tax income. The 42-year dividend streak gets a tailwind it hasn't had since the 1990s. Aflac reported Q1 2026 adjusted EPS of $1.75, missing the $1.79 estimate by 4 cents. Revenue of $4.35 billion beat the $4.2 billion estimate. The stock opened flat near its 52-week high. But the headline from Columbus, Georgia was this: the 43rd consecutive annual dividend increase, raising the quarterly payout to 61 cents per share.
Aflac Incorporated was founded in Columbus, Georgia in 1955 by John Amos and his brothers with $600 in startup capital. The company pioneered supplemental insurance, products that pay cash directly to policyholders when they are hospitalized or diagnosed with cancer. Aflac does not reimburse hospitals. It pays you.
At $60 billion in market cap, Aflac operates in two segments: Aflac Japan, the world's dominant cancer supplemental insurer with approximately 75% market share, and Aflac US, the growing employer-sponsored voluntary benefits platform. Japan represents approximately 57% of total revenue. The company's signature Rubber Duck marketing campaign, launched in 2000, drove brand awareness from 12% to 95% in 3 years. One of the most efficient brand campaigns in insurance history.
Q1 2026 revenue of $4.35 billion beat the $4.2 billion estimate, a 3.4% outperformance. Adjusted EPS of $1.75 missed the $1.79 estimate by 4 cents. Revenue grew 26% year over year versus Q1 2025, though that comparison is heavily distorted by investment portfolio gains and losses.
Adjusted EPS is the metric that matters for Aflac. The company strips out investment portfolio mark-to-market gains and losses, which drove GAAP EPS from 5 cents in Q1 2025 to $3.09 in Q3 2025 within the same year. Adjusted EPS of $1.75 in Q1 2026 represents 5.4% growth versus $1.66 in Q1 2025.
The Japan segment generated approximately 57% of total Q1 2026 revenue. Yen weakness versus the US dollar is the persistent headwind. Every 10 yen move reduces annual adjusted EPS by an estimated 15 to 25 cents. Japan's operating performance in yen terms has been solid, but dollar-reported results face a structural drag.
Aflac US represented approximately 39% of full-year 2025 segment revenue at $6.9 billion. U.S. voluntary benefits, supplemental health, dental, vision, and life sold through employer payroll deduction are growing at low single-digit organic rates. The employer distribution model drives high policy retention. Employees rarely cancel benefits deducted from their paychecks.
Capital allocation was the quarter's headline. Aflac repurchased approximately $883 million in shares during Q1 2026, consistent with an annual target of $2 to $3 billion. The quarterly dividend was raised to 61 cents, annualizing at $2.44. FY 2025 free cash flow was $2.56 billion.
AFL's balance sheet reflects the insurance model: total assets of $116 billion, predominantly investment portfolios backing policy reserves, cash of $6.25 billion, long-term debt of $8.4 billion, net debt of $2.2 billion puts leverage at 0.07 times equity.
Daniel Amos has served as chairman and chief executive officer of Aflac since 1990, 36 years, leading the same company with the same supplemental insurance compounding strategy. Amos is the nephew of founder John Amos. Under his tenure, Aflac expanded from a regional U.S. insurer to the global leader in supplemental cancer insurance. He has executed 43 consecutive annual dividend increases, one of the longest active streaks in the S&P 500.
Analyst consensus on AFL is hold, 9 buy ratings, 18 holds, and 5 sells. The average price target of $110.83 sits 4.6% below the current stock price of $116. That is a rare setup. The consensus view says the stock is already above fair value.
The bull thesis centers on capital return durability. Aflac's 43rd dividend raise confirms the streak extends regardless of quarterly earnings fluctuations. With approximately 5.9% of shares retired in FY 2025 through buybacks alone, adjusted EPS grows structurally even in years of modest operating gains. Income funds with dividend growth mandates absorb AFL shares regardless of valuation.
The cautious view from sell-side analysts focuses on the Japan structural overhang. Approximately 70% of Aflac's pre-tax earnings originate in Japan. New policy sales in Japan have been declining for several years as the working-age population contracts. The Japan business is a renewal engine, not a growth engine, and USD JPY above 145 creates a persistent currency headwind that the capital return story cannot fully offset.
Deutsche Bank and Morgan Stanley have hold and equal weight ratings respectively, with targets in the $105 to $115 range. The consensus view: AFL is fairly valued as a dividend compounder but not a growth stock. At 16 times forward earnings versus life insurance peers at 8 to 12 times, the dividend aristocrat premium is already priced in.
The consensus takeaway: AFL earns its premium multiple on the dividend record, not on earnings growth. The slight Q1 2026 EPS miss does not break the thesis, but the stock sitting above analyst consensus price targets means new buyers are paying a premium for the streak to continue.
The bull case is a 40-year compounding machine with a durable moat. Aflac Japan's 75% market share in cancer supplemental insurance is not a position competitors can replicate. It took decades of regulatory approvals and payroll deduction relationships to build. Each policy in the existing 24 million Japan book generates renewal premiums at near zero customer acquisition cost.
The buyback math is powerful. At $800 million to $1 billion in buybacks per quarter, Aflac is retiring approximately 5 to 6% of shares annually. A company with stable earnings and shrinking share count grows adjusted EPS in a straight line. The dividend aristocrat designation commands a structural institutional premium. Dividend growth funds, income ETFs, and pension allocators buy AFL regardless of price target models.
The yen is the optionality. With the JPY at multi-decade lows, any recovery toward 120 to 100 USD JPY adds an estimated 25 to 40 cents to annual adjusted EPS without any underlying business improvement.
The bear case starts with Japan's irreversible demographics. Japan's working-age population shrinks by approximately 300,000 people annually. New policy sales have been in structural decline for years. The Japan business is a renewal engine, not a growth engine, and demographic headwinds do not reverse.
Currency risk is asymmetric on the downside. If the Bank of Japan keeps policy accommodative and the yen stays above 140 per dollar, AFL's Japan earnings in USD face a sustained headwind. A prolonged weak yen creates multi-year compression in dollar-reported results even when Japan's local currency metrics are stable.
Valuation is the tactical risk. At 16 times forward earnings, AFL is the most expensive supplemental insurer in the U.S. peer group. MetLife at 9 times, Prudential at 8 times, Unum at 8 times. The dividend aristocrat premium is real but leaves no margin of safety if earnings disappoint. A re-rating toward peer multiples represents 25% compression or more.
Investment portfolio.
The life and supplemental insurance peer comparison, AFL versus MetLife, Prudential, Unum, and Globe Life. MetLife at 9 times forward earnings is the scale benchmark, $51 billion in market cap with diversified global insurance and retirement operations. Prudential at 8 times carries significant Asian exposure, similar to AFL's Japan footprint.
AFL at 16 times is the highest multiple in the peer group by a wide margin. The premium reflects three things: the dividend aristocrat status with 43 consecutive raises, the Japan cancer insurance moat at 75% market share, and the buyback machine that grows adjusted EPS through share count reduction regardless of operating conditions.
Unum at 8 times and Globe Life at 12 times are the closest product analogs. Both are supplemental and voluntary benefit insurers. AFL buyers pay twice the Unum multiple for the dividend streak and Japan scale. The gap is historically persistent but real.
The peer takeaway: AFL's premium is justified by the dividend record and Japan moat, but leaves no room for execution error. Japan demographics and yen headwinds mean the growth case rests on buyback math rather than top-line expansion. At 16 times, any earnings disappointment compresses the multiple faster than peers.
Pre-earnings options positioning was balanced at a put-call ratio of 0.85, slightly skewed toward calls given AFL's proximity to its 52-week high. The options market implied a 3 to 5% earnings move. The actual flat after-hours reaction confirmed that a slight EPS miss near a 52-week high is a neutral event, not a catalyst.
Dividend capture activity is a meaningful driver of AFL options flow around the quarterly ex-dividend date. The 61-cent quarterly dividend generates mechanical call buying from income strategies seeking dividend capture through synthetic positions, creating recurring support in near-term calls around each ex-date independent of fundamental views.
Daniel Amos's compensation is tied to adjusted EPS growth, Japan new policy sales, and return on equity targets. His 36-year tenure aligns his incentives with long-term capital return rather than short-term earnings management. The consecutive dividend raise streak is a direct output of that compensation structure.
AFL's capital return math is exceptional in the insurance sector. In FY 2025, $3.53 billion in buybacks plus approximately $1.23 billion in dividends equals $4.76 billion in total capital returned on a $60 billion market cap, a 7.9% capital return yield.
Aflac delivered. Revenue beat at $4.35 billion, 43rd consecutive dividend raise, $3.53 billion in FY 2025 buybacks. The 4-cent EPS miss is the yellow flag. Japan demographics and yen headwinds are the structural constraints at 16 times forward earnings.
Watch Q2 adjusted EPS versus $1.84, the gating metric. Japan new policy sales is the leading indicator for future growth. Dividend raised, buyback on track, capital return yield near 8%. Financial data and charts sourced from Financial Modeling Prep. Charged alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.